May 20th, 1999. A company goes public. The stock opens at $20. By the end of the day, it hits $86. That's a 330% increase in 6 hours. The company is now worth $7.8 billion. More valuable than Toys R Us, a company that's been selling toys for 50 years. Here's the thing. eToys has been in business for less than 3 years. They've never made a profit. Not even close. They lose money on every single sale. And they're about to lose even more. 20 months later, the same company files for bankruptcy. The stock is worth 9 cents. Employees get laid off via email. Warehouses full of toys sit empty. $300 million in investor money has vanished. This isn't a story about bad luck. It's not about fraud or scandal. It's not about a market crash destroying an otherwise healthy company. This is about something more fundamental, something that keeps happening. Over and over. A company that grew so fast, it forgot to make money. A business model that looked perfect on paper and completely collapsed in reality. This is the story of eToys, when growth became the strategy and profit became the afterthought. When scaling up meant accelerating failure, when every new customer was a liability, not an asset. Let's start with what eToys was trying to disrupt, the toy industry in the late 1990s. It's a $20 billion market in the United States alone. Worldwide, it's worth over $50 billion. This is a massive industry, but it's also incredibly challenging, dominated by big retailers. Toys R Us is the giant. 1,500 stores across America, $11 billion in annual revenue. Founded in 1948 by Charles Lazarus. Built on a simple premise: give parents everything they need in one place. Then you have Walmart, not primarily a toy retailer, but they sell more toys than anyone except Toys R Us. Target does the same thing. KB Toys has 1,300 mall locations. FAO Schwarz serves the luxury market. $500 stuffed animals, $10,000 dollhouses. These stores have something in common. They're seasonal businesses, extremely seasonal. 40% of annual toy sales happen between Thanksgiving and Christmas. Think about that. 6 weeks generate almost half the year's revenue. For those 6 weeks, these stores are printing money. Parents desperate to find the hot toy. Tickle Me Elmo. Furby. Power Rangers. Whatever kids are obsessing over that year. The rest of the year, these stores are just okay. January through October is about survival. Building inventory. Managing cash flow. Waiting for the holiday rush. Here's the challenge with toys as a business. They're low-margin products. A toy that sells for $20 might have a wholesale cost of $12. That's $8 in gross margin. 40% margins sound decent until you start subtracting costs. Rent for a 20,000 square foot store. That's $30,000 per month in a decent location. Employee salaries. You need 15-20 people to run a store. That's $300,000 per year minimum. Utilities, insurance, inventory carrying costs, marketing. By the time you add everything up, a toy store makes maybe 3 to 5% net profit. On good years, a toy that retails for $20, the store might make $1 in actual profit, maybe $2 if they're efficient, unless you're selling millions of toys. This is a tough business. You need scale, you need volume, you need operational excellence. That's why Toys R Us dominated. They had the scale. They had relationships with every manufacturer. Hasbro, Mattel, Lego, Fisher-Price. They could negotiate better wholesale prices, stock exclusive products, control the market. But there were inefficiencies, real ones. Walk into a Toys R Us during November. It's chaos. Narrow aisles packed with products, boxes stacked to the ceiling. Inventory management is a nightmare. Finding specific toys takes forever. Customers wander aimlessly. The checkout lines stretch to the back of the store. Parents are stressed. Kids are crying. Employees are overwhelmed. And here's the thing. Everyone hates this experience. The customers hate it. The employees hate it. Even the executives hate it. But nobody has figured out a better way. This is just how toy retail works. Until the internet arrives. 1995. Amazon.com launches. Selling books online. This seems insane to most people. Why would anyone buy books from a website? You can't flip through the pages. You can't see what you're getting. You have to wait a week for delivery. And enter your credit card online? That's how you get your identity stolen. But Jeff Bezos has a vision. Books are the perfect product for e-commerce. They're standardized. A copy of Harry Potter is the same everywhere. No variations, no fitting issues. They're lightweight, easy to ship, and there are millions of titles. No physical bookstore can stock them all. Amazon can. The value proposition is simple. Better selection, lower prices. Shop from home. No crowds, no parking. No dealing with bookstore staff who judge your choices. And people actually do it. By 1997, Amazon is doing $150 million in revenue. They're losing money. A lot of money. But revenue is growing 900% per year. The stock market loves this. When Amazon goes public in May 1997, the stock quintuples in the first year. Wall Street is realizing something. The internet changes everything. Or at least, they think it does. Here's the pitch that's circulating Silicon Valley. Physical retail is fundamentally expensive. Real estate costs a fortune. A big store in a good location. That's $50,000 to $100,000 per month in rent. Plus utilities. Plus maintenance. Employees cost money. You need people to stock shelves, run registers, help customers. That's $500,000 to $1 million per year per store. Inventory costs money. You need to stock products people might want, but you don't know what will sell. So you overorder. Then you're stuck with unsold inventory, taking up space, tying up cash, eventually sold at a loss. An online store needs none of that. No rent, or minimal rent for a warehouse in a cheap location. No retail employees, maybe some customer service reps, but far fewer people. No display inventory, just products in boxes, ready to ship. You can operate with half the costs, maybe a third. Pass those savings to customers. Undercut traditional retailers on price. Grow faster than any physical retailer could dream. Because you're not limited by geography. A physical store serves a 10-mile radius. An online store serves the entire country. The entire world. It's the perfect arbitrage. The internet versus the real world. Efficiency versus waste. The future versus the past. And the internet is going to win. Every smart investor believes this. Every entrepreneur sees the opportunity. The race is on to move every retail category online. Books, electronics, clothing, furniture, groceries, and toys. Meet the founder. Toby Lenk sees this opportunity. He's 32 years old in 1997. MBA from Harvard Business School. Before that, UCLA for undergrad. He's smart, analytical. Worked at Disney for 8 years. Strategic Planning Division. He knows the entertainment industry. He understands retail. He's studied the toy market extensively. And he sees the massive inefficiency. Think about the parent experience. It's December 15th, 10 days before Christmas. You need to buy toys for your kids. You drive to Toys R Us. The parking lot is full. You circle for 15 minutes. Finally find a spot. Walk inside. It's pandemonium. Hundreds of people. Screaming children. Half the shelves are empty. The hot toy your kid wants? Sold out everywhere. You search for alternatives. But you don't know what's age appropriate. The packaging is confusing. The employees are too busy to help. You spend an hour wandering the aisles. Grab some random toys. Hope for the best. Wait in line for 30 minutes to check out. Drive home exhausted. Repeat this for every child on your list. Grandchildren, nieces, nephews. It's a nightmare, a predictable, annual nightmare. Link has a simple insight. Parents don't enjoy toy shopping. They love their kids, but they don't love this experience. What if you could eliminate it entirely? What if you could buy toys from home, sitting at your computer at 11 p.m. after the kids are asleep? Browse the entire selection, read reviews, compare prices, add items to a cart, check out, and have everything delivered to your door. No crowds, no parking lots, no crying children in the checkout line, no stress. Just click and wait. This isn't just convenient, it's revolutionary. It's the future of retail. Or that's the pitch. Link knows the toy industry. He knows the margins. He knows the seasonality. He knows the major players. He's done the market research. And he's convinced this can work. Not just work. Dominate. Because he has something Toys R Us doesn't. No legacy infrastructure. No physical stores to protect. No existing business model to defend. He can build this from scratch. The right way. For the internet age, October 1997. eToys.com launches. The website is clean, simple design, easy to navigate, none of the cluttered chaos of a physical store. They stock 1,000 products initially. That's nothing compared to a physical Toys R Us, which might have 10,000 to 15,000 SKUs. But it's enough to start. The curated selection. Best-selling toys, age-appropriate recommendations, clear categories. Prices are competitive, sometimes lower than retail stores, sometimes the same. The shipping is the catch. $5 for standard delivery, $15 for rush delivery before Christmas. But Link is betting parents will pay for convenience. The first sales come in, slowly at first. A handful of orders per day, then dozens. Parents are actually doing this. They're buying toys online, entering their credit card information, trusting this website they've never heard of. First month, $30,000 in sales. Not bad for a brand new website. No advertising, just word of mouth and some press coverage. Second month, $50,000. The growth is accelerating. Third month, $100,000. This is the curve every investor wants to see. Exponential growth, month over month, compounding. By December 1997, the first holiday season, eToys does $1.5 million in revenue. In 1 month, that's 50% of their annual revenue, just like traditional toy stores. Seasonal. But it's working. Parents are discovering the site. They're ordering toys. The products arrive on time. Mostly. There are some hiccups. Some orders ship late. Some products are out of stock. But overall, it's a success. Customers are happy. They're coming back. Revenue for all of 1997, $2.3 million. In just 3 months of operation, the investors are excited. This validates the concept. Online toy retail works. The market exists. Now it's time to scale. But here's what nobody's asking. Are they making money on these sales? Let's look at a single transaction. This is where the story really begins. A customer orders a toy. It's a popular action figure. Retails for $20 on the eToys website. eToys pays the supplier $12 wholesale. That's standard for the toy industry. 40% margin. So eToys has $8 in gross profit. Sounds pretty good, until you add the costs. Shipping, $5. This is the killer. UPS charges eToys $5 to ship a 2-pound package. eToys charges the customer $5. So it's a wash, right? Not quite, because not every order is one item. Sometimes customers order multiple toys. The shipping cost goes up. But eToys still charges $5. They're losing money on shipping for larger orders. But let's assume a single item, $5 shipping cost, $5 shipping revenue. You're down to $8 gross margin. Now add the other costs. Credit card processing fees, $0.60. That's 3% of the $20 purchase. Website hosting and technology, $0.40 per transaction. Servers aren't free. Software licenses aren't free. Development costs need to be amortized. Customer service, $0.50 per order. Someone needs to answer the phone, handle questions, process returns. Packaging materials, $0.30. Boxes, bubble wrap, tape, packing slips. Now you're at $5.80 in margin, before you've paid for anything else. No marketing to acquire the customer. No warehouse rent. No warehouse employees. No executive salaries. No health insurance. No office space. No legal fees. No accounting fees. You're making $5 per order. And that's if everything goes perfectly. No returns. No damaged products. No customer complaints. No lost packages. Here's the reality. The toy industry has a 15% return rate. People buy the wrong size, wrong color, wrong age range. The toy doesn't work. The kid already has it. Every return costs money to process. You lose the shipping both ways. The product comes back damaged. Can't be resold at full price. Factor in returns. And your $5.80 margin becomes $4.50. Still doesn't sound terrible until you realize eToys is spending $15 to acquire each customer through advertising, marketing, partnerships. They're spending $15 to acquire a customer who generates $4.50 in margin on the first purchase. The math only works if customers come back multiple times. This is the customer lifetime value bet. But here's the problem. Customers aren't loyal. They buy toys where they're cheapest, or most convenient, or wherever has the specific toy they want. There's no loyalty to eToys specifically. The actual unit economics? eToys is losing money on most transactions, especially factoring in customer acquisition costs. But they have a plan, the plan that every money-losing startup has. Scale will fix everything. The pitch to investors is simple, compelling even. Yes, we lose money now, but that's because we're small. Scale will fix everything. Here's the logic. It's economically sound, at least in theory. Right now, shipping costs $5 per order. We're shipping 100 orders per day. That's 3,000 orders per month. UPS gives us a small discount, but not much. But if we ship 10,000 orders per day, that's 300,000 orders per month. We can negotiate much better rates, maybe $3 per order instead of $5. That's $2 in savings per order. Multiply by 300,000 orders. That's $600,000 in monthly savings, just from shipping volume discounts. Customer service costs $0.50 per order now. But that's because we're handling everything manually. Every call is unique. Every email requires a human response. With better software, better automation, better FAQs, and self-service options, we can reduce that to $0.20 per order. With 300,000 orders per month, that's $90,000 in monthly savings. Website and technology costs. Right now it's $0.40 per transaction. That's because we're running small servers, paying retail prices for everything. At scale, we can build our own infrastructure, negotiate better hosting rates, spread the fixed costs across more transactions. Maybe $0.10 per transaction. Another $90,000 per month in savings. Every fixed cost gets spread across more transactions. The warehouse lease. Right now we're paying $50,000 per month for 100,000 square feet. That's $0.50 per square foot per month. At current volume, that's $1.67 per order in warehouse costs. But if we 10x our volume, same warehouse, same lease, that cost becomes $0.17 per order. The warehouse manager makes $80,000 per year. With 3,000 orders per month, that's $2.22 per order. With 300,000 orders per month, that's $0.22 per order. The CFO makes $200,000 per year. The CEO makes $300,000. These are fixed costs. The more volume you do, the cheaper they become per unit. This is Economics 101, This is how every manufacturing company works. Build a factory for $100 million. If you produce 1,000 units, each unit bears $100,000 in fixed costs. If you produce 1,000 units, each unit bears $100 in fixed costs. Scale creates efficiency. This is true in manufacturing. This is true in logistics. This is true in technology. Why wouldn't it be true for eToys? Here's the problem. This math only works if you can actually achieve the scale. And it only works if customers keep buying. At the same prices, at the same margins, forever. And it only works if competitors don't emerge, forcing you into price wars, destroying your margins. All of these assumptions need to be true for the model to work. 1998. eToys is growing fast, really fast. Revenue hits $30 million for the year, from $2.3 million 1997. That's 13x growth in 1 year. This is incredible. This is what Silicon Valley dreams are made of. Investors are pouring in money. Sequoia Capital leads a Series A round, $10 million in funding. Valuation, $60 million. Then Idealab invests. Series B, $20 million. Valuation, $150 million. Then Benchmark Capital. Series C, $40 million. Valuation, $400 million. In 1 year, eToys has raised $70 million. The valuation has gone from $0 to $400 million. Each funding round comes with the same message. Grow faster, spend the money, capture market share, become the dominant online toy retailer before anyone else can. Profitability can wait. Because here's what everyone believes. The internet is winner take all. Network effects are real. First mover advantage is decisive. If eToys can become the biggest, they'll have brand recognition, customer loyalty, supplier relationships, infrastructure advantages. They'll be unbeatable. Look at Amazon. They were first in books. Now they own the category. Barnes & Noble launched an online store. Too late. Amazon already has the customers, the brand, the infrastructure. The same thing will happen in toys. eToys needs to be the Amazon of toys. Get big fast. Worry about profits later. So the strategy becomes simple. Spend money to grow. Lots of money. Spend it on marketing. Spend it on infrastructure. Spend it on people. Spend it on anything that drives growth. Revenue growth is the only metric that matters. This is the mantra. This is what the board repeats. This is what investors demand. Growth. 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 With $70 million in venture funding, eToys starts spending aggressively. The marketing budget for 1998, $21 million. That's 30% of their total funding. In 1 year, on marketing alone, they're running TV commercials during prime time, major networks, ABC, NBC, CBS. 30-second spots costing $100,000 each. They're buying banner ads across the internet. Yahoo, Excite, Lycos, AOL, every major web portal. They're sponsoring events, parenting magazines, radio ads, direct mail campaigns. The goal is simple. Brand awareness. Get the eToys name in front of every parent in America. Make eToys synonymous with online toy shopping. The marketing is working. Website traffic is exploding. January 1998, 50,000 visitors. June 1998, 500,000 visitors. December 1998, 2 million visitors. Conversion rates are decent. About 3% of visitors make a purchase. That's 60,000 orders in December alone. Revenue for 1998, $30 million. This is impressive growth. This is what venture capitalists want to see. But let's look at what it costs. The 1998 income statement is revealing, if you know what to look for. Revenue, $30 million. Cost of goods sold, $24 million. That's an 80% cost ratio, 20% gross margin. Wait, earlier, we said toys have 40% gross margins. What happened? Returns happened. Discounting happened. Free shipping promotions happened. The theoretical 40% margin becomes 20% in practice. So gross profit is $6 million. That's the money available to pay for everything else. Now the operating expenses. Marketing and advertising, $21 million. That's 3.5x the gross profit. Technology and development, $8 million. Building the website, maintaining servers, developing new features, shopping cart optimization, personalization algorithms, fulfillment and distribution, $14 million. This is warehouse costs, warehouse employees, packing materials, shipping subsidies. When customers order multiple items, and eToys still charges $5 shipping. eToys eats the difference. General and administrative, $9 million. Executive salaries, office rent, legal fees, accounting, insurance, human resources, all the overhead of running a company. Total operating expenses, $52 million. Gross profit, $6 million. Operating loss, $46 million. Read that again. They made $30 million in revenue. They lost $46 million. For every dollar they sold, they lost $153. This isn't a rounding error. This isn't a temporary situation. This is structural. The business model doesn't work at these economics. But here's what the investors see. Revenue grew 13x. The customer base grew 10x. Website traffic grew 40x. The metrics are all pointing up. The losses? That's just the cost of growth. That's what you expect with a young company. Capture market share now. Optimize for profitability later. This is the playbook. This is what Amazon is doing. This is what every successful internet company did. Lose money to grow. Then flip the switch to profitability. Once you dominate. But there's a difference. Amazon's unit economics were better. Their gross margins were 22%. But their fulfillment costs were lower. Books are easier to ship than toys. Amazon had product diversity. Books, CDs, electronics, multiple revenue streams, multiple customer touchpoints. eToys has one product category. Toys. Seasonal toys. Low margin, high return, difficult to ship toys. But nobody wants to acknowledge this. Because an IPO is coming. May 1999. eToys files for an IPO. Initial public offering. Going from private to public. Selling shares to anyone who wants them. The prospectus is filed with the SEC. This is a legal document. It must disclose all material risks. It must tell the truth. Page 3. We have incurred significant losses since inception. Page 4. We expect to continue to incur losses for the foreseeable future. Page 7. We may never achieve profitability. Page 11. We face intense competition from established retailers. Page 15. Our business is highly seasonal, and any problems during the fourth quarter could harm our annual results. This is the document they're using to raise money. It's remarkably honest. About the risks, about the challenges, about the uncertainty. And it's working. The roadshow begins. Toby Lenk and the CFO travel to New York, Boston, San Francisco, London, meeting with institutional investors, mutual funds, pension funds, hedge funds. The pitch is compelling. We're revolutionizing toy retail. The market is $20 billion in the US alone. Online sales are growing 100% per year. We're the leader in online toys. First mover advantage, best technology, strongest brand recognition. Here are our numbers. Q1 1999 revenue, $8 million. On 1998 revenue, $2 million. That's 400% year-over-year growth. Website traffic is doubling every quarter. Customer acquisition costs are dropping. As brand awareness grows, we're building distribution infrastructure. 2 warehouses, one in California, one in Virginia. East Coast and West Coast coverage. Next-day delivery for 75% of the US population. We have partnerships with major brands. Mattel, Hasbro, Lego. Exclusive online distribution deals. This is the future of retail. And we're leading it. The investors are excited. Some are skeptical. The losses are concerning. $46 million in 1998. Projected to be $80 million on 1999. But the growth The growth makes it worth the risk. Goldman Sachs is the lead underwriter. They're one of the most prestigious investment banks. They price the IPO at $20 per share, valuing eToys at $600 million. Before the IPO, the company will sell 8.2 million shares, raising $164 million. This is a massive amount of capital. This will fund growth for years, or so everyone thinks. IPO day, May 20th, 1999. The stock symbol is eToys. Trading begins at 9:30 a.m. Eastern. Opening price, $20. The price set by Goldman Sachs. Within minutes, $30, then $40, then $50. The demand is insane. Everyone wants shares. By 10 a.m., $70. By 11 a.m., $85. The stock peaks at $86, then settles around $76 at market close. That's a 282% gain. In one day, the company is now valued at $7.8 billion. Let's put that in perspective. Toys R Us, founded in 1948, 50 years in business, 1,500 stores, $11 billion in annual revenue, actually profitable. Market cap, $6 billion. eToys, founded in 1997, 2 years in business, 0 stores, $30 million in annual revenue, losing $1.53 for every dollar in sales. Market cap, $7.8 billion. The market is saying eToys is more valuable, despite having 0.3% of the revenue, despite never making a profit, despite losing money on every transaction. This is the moment when everyone should have stopped and asked a simple question. Does this make any sense? But they don't, because there's a logic to it, a compelling logic. That makes perfect sense. In 1999, here's the argument. It's not crazy, at least not on the surface. Toys R Us is a mature company. Their revenue growth is 3 to 5% per year. Slow, steady, predictable, but boring. They're not going anywhere. The market values them at 0.5x revenue. That's normal for retail. eToys is growing at 400% per year in 5 years. If they maintain even 50% annual growth, they'll have revenue of $2 billion. That's massive. They'll be a major player. Maybe not bigger than Toys R Us, but a significant competitor. And here's the key insight. All retail is moving online. This is inevitable. In 1999, online retail is 1% of total retail. By 2010, it will be 10%. By 2020, it will be 20%. The companies that dominate online will dominate retail. Toys R Us is stuck in the past. Physical stores, high overhead, slow to adapt. eToys is the future. Digital native, tech-enabled, customer-focused. In 10 years, eToys will be thriving. Toys R Us will be struggling or bankrupt. This is the bet. The market is valuing future potential, not current profits. Because in high-growth markets, current profits don't matter. Market position matters. And eToys has it. First mover advantage, brand recognition, technology leadership. This is worth $7.8 billion. Today, even if the current revenue is only $30 million, here's the problem with this logic. It assumes growth continues forever. It assumes competition doesn't emerge. It assumes customers remain loyal. It assumes the unit economics eventually work. It assumes the market share they capture translates to profits. Eventually. All of these assumptions need to be true for the valuation to make sense. If any one of them fails, the whole thing collapses with $164 million from the IPO. eToys has more money than ever. The pressure is immense. They need to justify the $7.8 billion valuation. That means growing even faster. The spending accelerates. New distribution center in Virginia, $30 million, state-of-the-art facility, 400,000 square feet, automated sorting systems, conveyor belts, computer-controlled inventory management, the most advanced toy warehouse in the world, expanding the California facility, $20 million, doubling the size, adding automation, more loading docks, more storage capacity. Marketing budget for 1999, $120 million. That's 6 weeks what they spent in 1998. and 4 to their entire 1998 revenue. They're spending $120 million on marketing to generate revenue that they lose money on. But the logic is clear. Build the brand, build awareness, capture customers, lock them in. Before competitors can, they launch massive TV campaigns, Super Bowl ads, $2 million for 30 seconds, holiday season commercials, during prime-time family shows. Toys for tomorrow, today. That's the slogan. It's catchy, memorable, positions eToys as innovative, forward-thinking. They sponsor events, parenting conferences, toy industry trade shows. They advertise everywhere. Billboards in major cities, radio spots, magazine ads, partnerships with parenting websites. The goal is ubiquity. Every parent in America should know eToys, should think of eToys. When they think of buying toys online, revenue response. Q1 $99.99, $8 million $999.99, $18 million $999.99, $27 million. The growth is accelerating. This is working, but the losses are accelerating faster. Q1 loss, $18 million. Q2 loss, $24 million. Q3 loss, $31 million. In 9 months, they've lost $73 million. They're burning through the IPO money at $8 million per month. But Q4 is coming, the holiday quarter. This is when toy companies make their money. This is when eToys will prove that the model works. The holiday season of 1999. It should be eToys' triumph. They've spent all year preparing. 2 massive distribution centers, $50 million in infrastructure, thousands of temporary workers, massive inventory, $40 million in toys, stocked and ready. The marketing blitz, $40 million spent in Q4 alone. TV ads everywhere, brand awareness at all-time highs. The orders start coming in. November 1st, slowly at first, then faster. Thanksgiving weekend. The website is slammed. Hundreds of thousands of visitors. Tens of thousands of orders per day. The servers are struggling. Website load times slow to a crawl. Some customers can't check out. The IT team scrambles. Add more servers. Optimize the code. They handle it. Barely. But fulfillment is becoming a nightmare. The distribution centers can't keep up. Orders are coming in faster than they can process. The automated systems are breaking down. Conveyor belts jam. Sorting machines malfunction. They switch to manual processing. Temporary workers hand-picking orders. It's slower. Less efficient. Orders start shipping late. A toy ordered December 1st. Promised delivery by December 10th. Ships December 12th. Arrives December 15th. Customers are angry. Wrong toys get sent. The Barbie dream house becomes a random action figure. The Lego set for an 8-year-old is actually for ages 12 plus. Packing mistakes, inventory errors, system failures. Some orders don't ship at all, lost in the warehouse, or out of stock. But the customer already paid. Customer service is overwhelmed. The phone lines are jammed. Hold times reach 45 minutes, sometimes an hour. Angry parents want their Christmas gifts. They paid good money. The toys better arrive, or they're disputing the charge. eToys is scrambling. They ship everything they can. Using expedited shipping, overnight delivery, 2-day delivery, whatever it takes. To get toys to customers by Christmas, this costs a fortune. Overnight shipping costs $15.25 per package. For packages, eToys charged $5 to ship. They're eating $10-20 per order. Just on shipping, multiply by tens of thousands of orders. But they have no choice. Customer satisfaction is critical. This is their reputation, their brand, their future. If parents don't get toys by Christmas, they'll never come back. So eToys does whatever it takes. January 2000. The holiday season is over. The accounting team tallies everything up. Q4 revenue, $507 million. That's incredible. More than triple Q3. More than their entire 1998 revenue in 1 quarter. The growth worked. The marketing worked. Customers came. They bought. Until you see the costs. Cost of goods sold, $77 million. That's 72% of revenue. Worse than the 80% they had been running because of all the discounting, price matching, holiday promotions, gross profit, $30 million. 28% gross margin. Now the operating expenses. Fulfillment costs, $40 million. Wait, $40 million for $107 million in revenue? That's 37% of revenue. Just to warehouse and ship products. The gross margin is 28%. Fulfillment costs are 37%. That means they're losing money before any other expenses, just on the core operation of storing and shipping toys. How is this possible? The expedited shipping, the overtime pay for warehouse workers, the temporary workers hired at premium rates, the equipment breakdowns requiring expensive repairs, the inefficiencies of manual processing. All of it. Then add marketing. $40 million in Q4. Technology. $5 million. General and administrative. $8 million. Total operating expenses. $93 million. Gross profit. $30 million. Operating loss. $63 million. Add interest and other expenses. Net loss. $68 million. In 1 quarter. They made $107 million in sales. They lost $68 million doing it. For every dollar of revenue, they lost 64 cents. Even after achieving massive scale. The unit economics aren't improving. They're getting worse. The IPO euphoria is fading. The spending has accelerated the losses, not fixed them. The holiday season, the 1 quarter that should save them, was a financial disaster. Competition is about to arrive, and the dot-com bubble is about to burst. Early 2000. While eToys is bleeding money, losing $68 million in a single quarter. Competition is arriving, and it's not small startups, it's giants. Amazon makes the first move, November 1999. Right during the holiday season, they launch Amazon Toys, a dedicated toy section, with thousands of products, competitive prices, free shipping on orders over $99. Amazon has advantages eToys doesn't. They already have millions of customers who trust them, who have accounts, who've bought from them before. They have distribution infrastructure, warehouses across the country, logistics expertise. They've been shipping books for years. Toys are just another category. They have technology, a world-class website, recommendation algorithms, one-click ordering. And here's the kicker. They can lose money on toys because they make money on books, on electronics, on CDs. Toys are a customer acquisition tool. Get parents buying toys. They'll come back for everything else. eToys can't compete with this. Then Toys R Us wakes up. Finally, after years of ignoring the internet, they launched toysrus.com, May 2000. They have advantages too. Brand recognition. 50 years of trust. Parents know Toys R Us. They grew up shopping there. Their kids shop there. There's loyalty. They have relationships with suppliers. Mattel, Hasbro, Lego. They get the best prices. The earliest access to new products, exclusive items. They have expertise. 50 years of knowing what toys sell, what ages want what products, what trends are coming. eToys has been around for 3 years, and Toys R Us has a physical store advantage. Buy online, pick up in store, return in store. The convenience of both channels. Walmart starts selling toys online. Target follows. Even KB Toys launches a website. Suddenly the market is crowded. The first mover advantage is evaporating. Being first doesn't matter if you're not profitable. Summer 2000. Amazon launches a price war. They start discounting aggressively. Popular toys. 20% off, sometimes 30% off. They're buying market share, losing money on every sale. But they can afford it. eToys cannot ignore this. If Amazon is 30% cheaper, customers will shop at Amazon. Simple as that. eToys has to match the prices. They have no choice. Or they lose customers. But remember the unit economics. eToys was already losing money at full price. Now they're discounting. 20% off means a $20 toy becomes $16. eToys paid $12 wholesale. That's $4 gross margin instead of $8. Shipping still costs $5. They're losing $1 just on shipping, before any other costs. Customer acquisition, warehousing, technology, overhead. Every sale is now losing 5 or 7 at least. And the more they sell, the more money they lose. This is the trap, when your model depends on scale. But you can't afford to compete for scale, because competition forces prices down. You're stuck. You can't win by being cheaper, because you're already unprofitable. You can't win on service, because Amazon's service is better. You can't win on selection, because Amazon has more products. You can't win on convenience, because Amazon has one-click ordering. The only advantage eToys has is specialization in toys. But that's not enough. Not when you're bleeding cash, and the competition has deep pockets. Let's look at the cash flow. This is where it gets scary. Q1 2000, $35 million loss. Q2 2000, $44 million loss. Q3 2000, $52 million loss. The losses are accelerating, even as revenue grows. Q1 revenue, $25 million. Q2 revenue, $32 million. Q3 revenue, $38 million. Revenue is growing, but losses are growing faster, much faster. In 9 months, they've burned through $131 million. The IPO raised $164 million. They had about $180 million in cash at the start of the year, after the IPO and some other funding. By October 2000, they have $49 million left. At the current burn rate, $40 to $50 million per quarter. They have 2 quarters, maybe 3, before the money runs out, unless they raise more. But there's a problem. The stock market is changing, dramatically. March 10th, 2000. The NASDAQ peaks at 5,048. This is the top, the height of the dot-com bubble. Everyone is euphoric. Internet stocks can only go up. Then reality sets in. March 13th, NASDAQ drops 4%. March 14th, down another 3%. April 2000, down 15% for the month. May 2000, down another 10%. Investors are getting nervous. All these internet companies, burning cash, promising future profits. But when? Nobody can answer that. Pets.com is burning $20 million per quarter. Webvan is burning $50 million per quarter. Cosmo.com is burning $30 million per quarter. eToys is burning $40 million per quarter. None of them are close to profitability. Maybe the model doesn't work. Maybe you can't just burn cash forever and hope to flip profitable. Maybe some businesses don't translate online. The selling begins. eToys stock is falling from a high of $86 in May 1999, down to $50 in March 2000, then $30 in April, then $15 in June, then $8 in August. By September 2000, the stock is at $5. The market cap is $500 million, down from $7.8 billion. They've lost 94% of their value. In 15 months, the company hasn't changed. The business model is the same. The losses are the same. But the market's perception has shifted. Growth isn't enough anymore. Profitability matters. And eToys has no path to profitability. August 2000. eToys announces a new strategy. They're diversifying. Beyond toys, they launch babycenter.com, a parenting resource website, articles, forums, advice. They acquire it for $205 million in stock. The idea is customer lifetime value. Parents buy toys, but they also need information, parenting advice, community. Baby Center has 5 million monthly visitors. Monetize that traffic through advertising, through e-commerce. Sell baby products. Then they launch babyuniverse.com for baby products, diapers, strollers, clothing, car seats, formula. The pitch makes sense. On paper. You acquire a customer buying toys. You sell them baby products too. Higher customer lifetime value, better unit economics, spread acquisition costs across more purchases. Here's the problem. They're now competing in more markets. against more competitors. Diapers.com exists. Amazon sells baby products. Walmart sells baby products. Target sells baby products. And eToys still has the same broken unit economics. Low margins, high shipping costs, high customer acquisition costs. Adding more product categories doesn't fix the fundamental problem. It just spreads the losses across more areas. This isn't a strategy. This is desperation. Trying anything to find something that works before the money runs out. By September 2000, the writing is on the wall. Smart investors are getting out. Insiders are selling stock as much as they legally can. Executives are leaving. The CFO resigns, takes a job at another company. The COO is fired. Performance issues. The head of marketing quits. Sees the end coming. New hires stop accepting offers. Why join a sinking ship? The company tries to reassure everyone. Internal emails. All hands meetings. We're on track. Q4 will be different. We've learned from last year's mistakes. The infrastructure is ready. We'll be profitable in Q4, or at least close to it. Toby Lenk does interviews with the press, CNBC, Bloomberg, the Wall Street Journal. He's optimistic, confident. We're on track for profitability. Q4 will be transformational. The market doesn't understand our model. We have 18 months of cash. We're in great shape. But internally, everyone knows they're running out of time. The cash is evaporating. Q4 needs to be perfect, not just good. Perfect. Or it's over. Holiday season 2000. This is eToys' last chance. They need a perfect quarter. Revenue needs to explode. Costs need to drop. Margins need to improve. They need to prove the model works at scale, profitably instead. The opposite happens. Traffic is down, year over year. Fewer people are visiting the site. Some are shopping at Amazon. Amazon has better prices, better selection, better service. Some are going back to physical stores. The convenience of online isn't worth the hassle. Late deliveries, wrong products, difficult returns. Just drive to the store. Marketing spend is massive. $45 million in Q4 alone. Trying to win back customers. Trying to compete with Amazon. Trying to capture market share. But it's not working. The brand is damaged. Trust is broken. Revenue comes in $120 million. That's actually up from last year's $107 million. So revenue grew by 12%. Seems good, until you see the costs. Cost of goods, $88 million. Gross profit, $32 million. 27% gross margin. Worse than last year. Because of price competition, more discounting, more promotions. Fulfillment costs, $45 million. Even higher than last year, 38% of revenue. The warehouses are less efficient, not more efficient. Lower volume means higher per unit costs. Fixed costs spread across fewer orders. Marketing, $45 million. Technology, $6 million. General and administrative, $10 million. Total operating expenses, $106 million. Gross profit, $32 million. Operating loss, $74 million. Net loss, $82 million. In one quarter, they made $120 million in sales. They lost $82 million. That's a 68% loss rate. For every dollar of revenue, they lost 68 cents. After 3 years in business, after an IPO, after raising $300 million, after building state-of-the-art infrastructure, the unit economics are worse than ever, and the money is gone. January 2001. eToys has $20 million in cash. Maybe. They're burning $25-30 million per month. They have weeks, not months. Lenk tries to raise emergency funding. They need $50 million. Just to survive until summer. Maybe Q2 can turn things around. Maybe they can cut costs enough. To reach break-even, he talks to venture capitalists, Sequoia, Benchmark, the firms that invested early. Nobody wants to invest more. The model is broken. He talks to strategic investors, toy manufacturers, retail companies, private equity firms. Nobody wants in. He talks to banks about debt financing. They won't lend. Too risky. The due diligence is brutal. Every potential investor asks the same questions. How do you ever make money? When do you reach profitability? What's your path to break even? There are no good answers. The unit economics are broken, have been from day one. Competition is crushing them. The brand is damaged. The market opportunity is smaller than thought. There's no path, no scenario, where eToys becomes profitable, at least not before running out of money. February 27, 2001. The board meets, emergency session. The options are clear. Raise money. Not possible. Cut costs to break even. Not enough time. Sell the company. No buyers. File for bankruptcy. Only option. The vote is unanimous. Bankruptcy. February 27, 2001. eToys announces they're closing immediately. Filing for Chapter 11 bankruptcy. The email goes out to employees. Subject: important company announcement. Effective immediately. eToys is ceasing operations. Most employees are laid off. Today. Final paychecks will be issued. No severance. Benefits end in 30 days. The warehouses are shut down. Inventory is liquidated. Toys sold for pennies on the dollar. To discount retailers, liquidation companies, whatever they can get. The website goes dark. Just a message. Thank you for shopping with eToys. We appreciate your business. From IPO to bankruptcy, 21 months, one of the fastest collapses in corporate history. Let's look at the complete picture. Total revenue in eToys' lifetime. From October 1997 to February 2001, $237 million. Sounds like a lot, until you see the losses. Total losses, $398 million. They lost $168 for every dollar of revenue over the entire life of the company. Total funding raised. Venture capital, $70 million. IPO, $164 million. Other investments, $66 million. Total, $300 million. All of it, gone. Investors lost everything. The stock that traded at $86, worth 9 cents at bankruptcy, then zero. Employees lost their jobs, about 100 people. No severance, no warning. Many had stock options, worthless. Suppliers lost millions in unpaid invoices. Toy manufacturers owed money. Shipping companies owed money. Landlords owed money. They'll get pennies on the dollar in bankruptcy proceedings. The only winners? The lawyers handling the bankruptcy. They'll make millions. March 2001. Toys ER. Us makes an offer. For the eToys brand and website, $5.4 million. A brand that was valued at $7.8 billion, sold for $5.4 million. That's 0.07% of peak value. Toys R Us relaunches eToys.com as a redirect to toysrus.com. The eToys brand exists, technically, but it's meaningless. Nobody uses it. Eventually, it's discontinued entirely. The distribution centers are sold to Amazon. They buy the Virginia facility for $10 million. eToys spent $30 million building it. Amazon gets it for a third of the cost. The technology is sold to various buyers for almost nothing. The patents, the software, the algorithms, worth millions in development costs, sold for thousands. The customer list has no value because the customers are gone. They're shopping at Amazon, at toysrus.com, at Walmart. Everything that was built, the infrastructure, the brand, the technology, the customer base, gone in weeks, as if it never existed. What killed eToys? Here's what killed eToys. Not competition, not timing, not bad luck, not fraud, unit economics. From day one. They lost money on every sale. The plan was always, grow big enough. Scale will fix everything. It never did. Because the fundamental problem wasn't scale, it was structure. Shipping toys is expensive, especially compared to books. Books are dense, heavy for their size. You can ship 10 books for the price of one large toy. Toys are bulky, light, inefficient to ship. The shipping costs don't improve much with scale. UPS and FedEx have volume discounts, but only to a point. You might get 30% off at high volume. That's not enough when you're losing money on every sale. And you can't charge customers more because competition forces prices down. eToys had no cushion. Amazon could lose money on toys because they made money on books and electronics and eventually everything else. Walmart could lose money online because they made billions in stores. eToys had one product category, toys, and they lost money on all of them. Every sale was a liability, not an asset. The faster they grew, the faster they burned cash. Growth was killing them, not saving them. There's a dangerous idea that permeates Silicon Valley. Still does today. Growth solves all problems. If you're growing fast enough, investors will fund you. Customers will come. Eventually, you'll figure out profitability. Just keep growing. eToys believed this. So did their investors. They spent $120 million on marketing to acquire customers that they lost money on. This isn't a business model. It's a bonfire. You're pouring money in, hoping eventually it becomes sustainable. Sometimes this works. Amazon lost money for years, 6 years, before becoming profitable. But Amazon had better fundamentals, better unit economics, better product diversity, better infrastructure advantages. And even Amazon came close to failing. Multiple times. eToys had none of those advantages, just the belief that growth would save them. It didn't. The IPO valuation, $7.8 billion for a company losing $1.53 per dollar of sales. This was insane, even in 1999. But it made sense to the people buying the stock, because everyone believed. The internet changes everything. Old rules don't apply. Profits don't matter. Revenue growth is all that counts. Capture market share. Dominate the category. Profitability will come later. This wasn't fraud. The prospectus was honest. It said they might never be profitable. Everyone knew the risks. They just didn't believe them. Because the stock kept going up. Until it didn't. The market can stay irrational. Longer than you can stay solvent. Unless you're the company. Then the market's rationality arrives faster than you expect. Toby Lenk wasn't a villain. He saw a real problem. Parents hated toy shopping. The experience was terrible. Crowded stores, poor selection, high prices. He built a solution. It just didn't work economically. The vision was right. The execution was sound. The economics were broken. The employees weren't stupid. They worked insane hours, believed in the mission, built impressive technology, state-of-the-art warehouses, lost everything overnight, through no fault of their own. The investors weren't fools. Some of the smartest people in finance, Harvard MBAs, Stanford graduates, decades of experience. They bought into a story. That seemed logical, until it wasn't. This is what makes eToys fascinating. Nobody did anything evil. Nobody committed fraud. Nobody lied to investors. Everyone followed rational incentives. The founders wanted to build something meaningful. The investors wanted returns. The employees wanted to be part of something big. The customers wanted convenience. All rational. All logical. And it still collapsed. Because the math didn't work. And no amount of belief, or hard work, or smart people can fix broken math. eToys teaches us something uncomfortable. Growth can kill you. Faster than stagnation. If you grow without sustainable economics, you're just accelerating toward failure. Every new customer is a liability. Every dollar of revenue costs $2. The faster you grow, the faster you die. This is counterintuitive. We celebrate growth. We worship scale. We believe bigger is better. But bigger only matters if the unit economics work. Otherwise, You're just losing money faster, at a larger scale. The lesson isn't, don't grow. The lesson is, don't grow faster than your unit economics can support. Don't assume scale will fix fundamental problems. Don't confuse revenue growth with value creation. They're not the same thing. We still see this pattern. Today, companies raising billions, growing revenue fast, losing money faster. Uber lost $8 billion before profitability. WeWork never figured it out. MoviePass burned through $200 million in a year. Bird scooters, Lime scooters, Deliveroo, Grubhub. The pitch is always the same. We'll figure out profitability later. Right now, we need scale. We need market share. We need growth. Sometimes it works. Uber eventually became profitable, after 15 years. Usually it doesn't. The graveyard is full of companies that grew fast and died faster. The eToys story isn't ancient history. It's a warning that we keep ignoring because the temptation is too strong. The allure of growth, the promise of scale, the dream of dominating a market. It's intoxicating for founders, for investors, for employees, for everyone involved until the money runs out and reality arrives. In the end, eToys lasted 43 months. From launch to bankruptcy, they sold 237 million in toys, lost 398 million doing it, created 1,100 jobs, destroyed all of them, generated 7.8 billion in market value. On paper, watched it vanish. In 21 months, the toys are still selling, just at different stores. Parents are still shopping online, just on different websites. The problem eToys identified was real. The solution they built was elegant. The vision was correct. They just couldn't afford to get there. Because sometimes the problem isn't the vision, it's the math. And when the math doesn't work, no amount of growth, no amount of marketing, no amount of belief can save you. Growth just speeds up the inevitable. The faster you grow, the faster you hit the wall. eToys saw the future. They just couldn't survive long enough to reach it.